everyone, welcome to another video. Today we're looking at classified balance sheet, the horizontal style. Alright, so let's get into it. First, we want to find out what a balance sheet is. It's a financial statement that shows a business financial position at a particular time. And when we talk about the financial position, we're talking about the assets, liability, and capital of the business. So businesses will, in the accounts department, will prepare this financial statement to show what is going on in the business as it regards to the assets, liability, and capital. But what are assets, what are liability, and what is capital? So assets are the things that are resources that the business owns and will earn their income from. So they own these things. So they have bought them, they own them. So we're talking about cash. We're talking about bank. The bank, and when we talk about bank, we're talking about the money that they have in their bank account. We're talking about building, machinery, motor vehicle, equipment, their debtors, also known as accounts receivable or trade receivable. We're talking about stock, inventory, fixtures, and fittings. So the resources that the business owns, we call those assets. All right, and so we're going to move on to look at the categories of assets or the types of assets. We have fixed or non-current assets and we have current asset. What do we mean by fixed or non-current asset? These are resources that the business owns that will be in the business for over 1 year. So any resource that they have that will be there for more than a year. Now we're talking about our land and building, the machinery, motor vehicle equipment, fixtures, and fittings. So these will normally stay in the business for more than 1 year. And then we have our current assets. These are the assets, the resources that the business owns that may be used up within 1 year. So they'll spend their cash, they'll spend the bank money in the bank account, their debtors. So their debtors will increase and decrease over the period. And when we talk about debtors, we're talking about persons, their customers who would have purchased from the business and they owe the business. So they took goods on credit. So they are assets to the business because the money that they owe the business belong to the business. It is the business's money. So they're seen as current assets. And once they pay, they're no longer a debtor. So that's why we said it's used up or we get it within 1 year. And then we have stock. These are the items that the business own that they will be selling on a day-to-day basis. So they buy them to sell them back. All right, so let's continue. We have the liabilities. Now, liabilities are claims on the resources that the business owns. In other words, liabilities are what or who the business owes. So persons, individuals, other businesses that this business that we are dealing with owes. So if we're doing things for K. Saunders' business, who are the persons that K. Saunders owe? The persons that K. Saunders owes will be the liabilities, all right? And they will have to pay back these funds. So like, for example, a mortgage. This is a loan that you have taken out that it takes many years to pay back, 15, 20, 30, 40 years to pay back for building. So it's a building loan. Your creditors, also known as trade payable, accounts payable. These are the persons who you bought, your suppliers, who you bought stock from on credit. So you will have to repay them or you would have to pay them for the goods that you took from them on credit. So again, if K. Saunders go out and get goods from, let's say, a hardware and they did not pay the hardware for the goods that they got from the hardware now becomes their creditor, because they now owe that hardware. And then we have bank overdraft. This is where the business used more money than they actually had in their bank account. So yes, businesses will have bank accounts, but the bank will allow for them to take more than they have in their account. So if they had $10,000 and they need $20,000, the bank will allow for them to take the additional, but they will have to pay back the bank that money because it wasn't theirs in the first place. So And when I say pay back the bank, I'm talking about the extra $10,000 that they got to pay what they wanted to pay, because they already had money in the bank, but they took more than what they had. So they have to pay back the excess to the bank. And then other loans that you will get from other individuals, family, friends, those would be seen as liabilities because you will have to pay them back. So we have the categories of liabilities. You have long-term liabilities and current liabilities. Your long-term liabilities are basically the debts that the business that you are looking at, that has more than a year to pay back. So they will have 2 years, 3 years, 4 years, or even more to pay back the money that was given to them. So we're looking at mortgage and loans because these tend to be paid back in more than a year. And then you have current liability. These are debts that the business has less than a year to pay back. So they'll have a couple months to pay back, but it's not going to be over the year. So that they're creditors. So everybody that they got goods from, their suppliers, they will have to pay them back within a month, 2 months, 3 months, right? And then the bank overdraft, they will have to pay back the bank for any money that they took in excess of what they had in their bank account. So these are the current liabilities. Now, when we talk about capital are resources that is put into the business by the owner. So the owner is the one that put those resources in. So they can actually do so at the start of operation or throughout the life of the business. So the owner may put $20 million in the business to start the business, and then throughout the next years of the business, the owner may put in additional funds or put in an appliance or an equipment into the business. So that is their capital because it is placed in the business by the owner. Now we're looking at the accounting equation. Now, in order for us to go about doing the balance sheet, we have to understand what equation we use for it. So this can be called the balance sheet equation. Or assets is equal to capital plus liability. Again, if you're focusing on a business, this is the business assets, capital, or liability we're looking at, not another person, no one outside. We're looking at that particular business. So from time to time, you will hear me say we or I, because it helps you to understand that you are referring to the business at hand. All right, and when you see yourself as a business, what's going out and what's coming in, it makes it easier for you to recognize if it's an increase or a decrease, if it's an asset or a liability. Why is asset equal capital plus liability? Because the assets that are in the business were given or placed into the business by the owner, which is the capital, as well as from resources from other individual or business. So the creditor will allow for me to take the goods. Those goods coming to the business are now owned by the business and they are now assets. The owner puts in funds into the business. That becomes our cash. And then from there, we can buy equipment. So our asset is equal capital plus liability. If, however, you are not given the capital figure, you can find the capital by minusing liability from asset. So once you have your asset figure, things that we own, we minus the amount that we owe, and once we minus that, we will be able to know how much it is that the owner had placed in the business. If we do not have the liabilities, we can also find that because liabilities equal assets minus capital. So we just transpose the formula. So we made capital the subject here and liability the subject here in order to find the amount for each. Liability is equal to asset minus capital. All right, and we can even expand the formula a little bit more because asset, remember we said there are two categories, non-current and fixed. So when we add these together, we should get the total assets. And then capital, there's no category right now. And then for the liabilities, we have long-term liability and current liability. So we add those together to get the total liabilities. So if you're not given asset, capital, and liability just like that, you're given the different types, you should still be able to find what each is equal to. All right, now we're going to be looking at creating a classified balance sheet, the horizontal slide. All right, so the question says, from the following information, prepare K. Saunders' balance sheet as at December 31st, 2005. So you're doing the balance sheet for K. Saunders. He's the name of the business. The owner is K. Saunders. It has all the information. These would be your assets, your liabilities, and capital. So you're going to go ahead and prepare the balance sheet. So the first thing you do in preparing the balance sheet is to write the name of the business. Then you write the name of the statement that you're preparing, the financial statement that you're preparing, and that's the balance sheet, and you're going to put the date. All right, now I need 6 columns, 1 column for the heading asset, 2 other columns for the figures, and then I have capital and liabilities. Let's extend this column, and then I have my $sign. All right, let's make this bold as well. So I'm going to ensure that the headings are at the center. So I'm just going to use this feature of Excel to ensure that they're at the center of the table. And then I'm going to underline the heading. All right. I'm going to also have the line in the center. All right, so I have that line. I'm going to change the size of it so that I can add the line for the rest of the columns. So I'm going to add a line here and another one in front. Do the same thing here. So what I'm doing is creating my columns so that it's easy for me to view the numbers or place the numbers. All right, so I have my columns. These are my headings. So these are subheadings. This is the heading for the balance sheet. So I'm going to go ahead, and the first thing I'm going to do is, according to the order of permanence, put in the assets that will stay the longest in the business first, over 1 year. So I'm going to start off with my non-current assets. This is also a heading, so I'm going to bold it and underline it. All right, now I must look in the list here for the non-current. So the non-current would be fixtures, motor vehicle. There's no other. Now fixtures tend to stay in the business longer time. Our fixtures are like our plumbing, the lighting, etc. So they'll normally be in the business for our K. Saunders business for a long time because they will not be changed quickly. So we have fixtures, and then we have motor vehicle. So I'm going to put the figures in the first column, seeing that I need to add them to find what's the total non-current asset. So I'm going to include those. Once I have them, I am going to underline the last one to show that I'm going to be adding these two together. And this figure I'm going to call my total non-current assets. So I'm going to widen my column a little bit more. All right. So this would be my total non-current asset. Then I'm going to go ahead and do my current assets. It's bold and underline. Now I'm going to look for my current asset, things that I own or K. Saunders own. One of the reasons why I said I is because it's easier for me to look at the business from my perspective. So I know I'm doing it for K. Saunders, but I'm treating myself as K. Saunders, so I will know what I own and what I owe for. Okay, so I'm going to look for that. So we have stock of goods, we have debtors, cash at bank, cash in hand. All right, so these are things that we actually would own, but we'll own them for a shorter period of time, less than a year, because we're going to use them up during the year. So our stock, to put our total in the first column. Then we have our debtors. This is the order of permanence, because stock will be in the business for a longer time. It will take 4, 5, or even more months for me to sell my stock, but my debtors will have to pay me back within a short time, so I put it afterwards. Debtors are persons that owe the business, so I would have my customers, so I would have sell items to them from my stock and they did not pay. They take it out on credit or trust, and so I will have to wait on them to pay me back. The money that they will need to pay me is an asset because it is mine. They have taken the goods and they now owe me that money. So I'm going to put my debtors, cash at bank, or just bank, or cash in hand. So I'm going to put my cash at bank and my cash in hand. Underline, then I'm going to add. Because I'm about to use a function sum, but I refrain. Alright, so I have my total current asset. Alright, and then I'm going to start my next side. I won't find a grand total as yet. I want to ensure that this side is okay. So I'm going to have capital. Go and put it in the second column because there's only one figure for capital. And then I'm going to start with my long-term liabilities. Now, in this question, let's look if there's any long-term liability. I owe money that K. Saunders would owe to someone else. I remember we said we're treating ourselves like this is our business. So we would have owed the loan to R. Sims. So that's a long-term liability because we don't have to pay it back within a year. We can wait over a year. As you can see, 3 years. So I have up to 3 years to pay back this loan. So that's a long-term liability. So I'm going to write that loan from R. Sims 1. So I just write it in the second column. As you can see with the first set, because I had more than one items to add under each, that is why I did that in the first and then put the total in the second. But if it's only one, I can go ahead and put the figure into the last column. So I'm going to do my current liabilities. Bold and underline. Now I'm going to look through and see if I see any. I've used capital, fixtures, loan is a long term, motor vehicle is a fixed asset, stock of goods is a current asset, creditor. Now creditor, persons who K. Saunders will have to pay back within less than a year. Now, as we say, creditors, persons who they would have taken goods from and have not paid. So they are going to be a current liability. So we're going to go ahead and put in the total. Cash at bank, cash at hand, we had already placed in our current asset column. All right, so we're finished with both sides. Now, the task is to add up both sides. Now, what I'm going to do is I'm going to use the last row, the side that has the most information. I'm going to use the last row to determine where I'm going to put my total. So I cannot put my total here and then have another total here. So I have to ensure that, seeing that the asset side is the longer side or more information is on the asset side, I'm going to put the total after the last information. So my total will go here. And for this side, it will go here as well. So this is known as the total assets. So I'm going to add this figure, the total non-current, with the total current, and I will get my total. Then I'm going to add capital plus my long-term plus my current, and I'm going to get the total. If you realize both sides is the same, one of the reason is that asset is equal to capital and liability. So whatever figure I get on this side, it should be the same as the total that I get on this side, because I would have purchased fixtures, motor vehicle, my stock, and have persons owing me and cash at bank from what was put in the business by the owner, the capital, as well as my loan and the creditors. All right, so I'm going to go ahead and I'm going to underline that. But if you recognize, I double underline the final figure to show that we are finished, and I put it on the side that has the most information so that it's not in different rows. All right, and that is your classified balance sheet, the horizontal style. Okay, so there are times when you prepare your balance sheet from information, but then transactions will take place and that will affect the figures that will appear on the balance sheet. So I'm going to show you how these transaction meaning that we buy things or we sell things, we engage in the exchange of goods and services. So once those things happen, it will cause the balance sheet to change, the figures to also change. And so we're going to look at that now. So here we are. Those were the information that was before, and then we have some transactions. So let's look at the first one. Bought $2,000 worth of goods on credit. Now, once we say that we bought goods, goods is stock. So let us say, so we have stock. And then it says on credit. Therefore, it means that we owe someone. When we owe anyone for goods that we bought from them on credit, that is our creditors. So the two things that will be affected on the balance sheet would be stock and our creditor. All right, so let me just bring this over a little bit. The next thing is that what is happening to stock? If I buy stock, it means that the amount 6,250 that was there is going to go up because I buy more, I purchased more. So what I'm going to do, I said I purchased 2,000 worth, that's going to change my stock of goods figure. So I'm going to add the 2,000 to it because it is increasing the stock. Now, I also took it on credit. Therefore, it's going to cause my creditor figure to change. Now, my creditor figure is also going to go up because of the fact that I bought more things. So it means I owe more persons. So I'm going to add the 2,000 to it. All right. And another thing that we must remember, the rule, stock is an asset and then creditor is a liability. When stock or assets increase, the liability also will increase. So if we add to the asset, we have to add to the liability. All right. So the owner puts $5,000 cash into the business. When the owner puts money into the business, that will affect our capital. What did he put in? Cash. So that will also affect our cash. Now let us look at what is happening to capital. The owner puts more into the business. Therefore, the capital is going to increase. And then what did he put it into? Cash. Or what was put in? Cash. Therefore, our cash in hand is going to also increase because we're getting more cash. The business is getting more cash. So we're going to add 5,000 to that. So when capital increases, the asset also increases. When capital decreases, the asset will decrease. All right. And as I said, decrease means you less from the figure that was there before or you add to that figure. Now let's look at C. Repaid $2,000 to RSIM. Who is RSIMs? It's a loan we had from RSIMs and the loan was a long-term liability. So we repaid $2,000 on it by check. So definitely this is going to be the loan from RSIMs that will be affected. or will change. So when I said affected, I mean that it will be changed. And then it says by check. Now, of all the things that is actually on the balance sheet, when we see the word check, it is cash at bank or bank. All right. So once it's check, it is cash at bank. So that's bank. Now, what is happening to loan? Since I give R. Sims money that I owe him, once I pay him, it means that I will not owe him as much anymore. So what I will do is from the $4,500, I'm going to minus the $2,000 because I paid him $2,000 out of the $4,500. So now I will owe him $2,500. So that's decreasing the loan amount. Now I use that check to do that. So I paid out money. So once I paid out money, it means that the money is leaving the business. So I will no longer have that money in my account. So the bank balance is going to also decrease by the $2,000. So if you look, I minus the $2,000, and when I minus the $2,000, reducing it, I also minus the $2,000 because, let me write it here. Once an asset is affected and a liability, you are going to definitely, let me bring this over. So once the transaction affects an asset and a liability, if it causes both to go up, you are going to add, right? Now, if it decreases, you're going to minus. But both must be added if you're increasing, or both must be minus if it is decreasing. So when it's an asset and an asset, then one will require adding and the other will require minus. So you add to one and minus from the other. The same thing with asset and capital. You either add both or minus from both. If it is a liability and a liability, you are going to add one and minus from the other. All right, so let us continue. Receive 3,000 cash from a debtor. So we receive cash. So the cash is going to change and debtors is going to change. Right? So what is going to happen to the cash? We're getting, so it says receive cash. So we're getting cash. So we're going to change our cash in hand. All right? So because we're the business, we, Case Saunders, is getting the money, we're going to add 3,000. Right? And then the debtor is going to change. Because remember, it says when it's an asset and an asset, one will add and the other will minus. So we already add the money to the cash in hand because we're getting that money. But now it's causing us to lose debtors because we will no longer have that person as a debtor because they have now paid us. So they don't owe the business anymore. So we're going to minus the 3,000 from that. So one we add and the other we minus. All right. And then the next one says bought an equipment for 5,000 using cash. So the two things affected based on the transaction is that an equipment was bought and then we used cash. These two are assets. What did we say about when two assets are affected? One must be added to and one must be minused from. All right. So we're going to look at that. So the cash in hand is going to change. Right. Remember, check is bank while cash is cash in hand. So let's look at it. We bought an equipment. We never had any equipment before. So we're going to have to include that now. Now, because we bought it, it is now owned by us. It is increasing. So we're going to put the 5,000. right? And then when we bought it, we used money to buy it. So that money is leaving the business because we're spending. So we're getting the equipment because we bought it, but we're using money, so the money is going to reduce. So we're going to less the 5,000. All right, I hope we understand what took place. So once we read the transaction, we must know which two or more assets or liabilities affected, be able to identify them, and then we're able to change the figures based on whether it increased or decreased. So if it's an asset and a liability, we have to know that both of them will do the same. So it's going to either add both of them or minus from both of them. If it's an asset and an asset, one you're going to add and the other you're going to minus. If it's asset and capital, both the asset account and the capital account, we will have to add to both of them, or we're going to minus from them if it's decreasing. If it's a liability and a liability, one we add to and the other we minus from. All right, so let's make sure that we understand that clearly. All right, so since we have done that, we are going to prepare a new balance sheet based on the changes that we made to each of the figures based on the transactions. So we're going to go ahead, write K. Saunders balance sheet as at January 31st, 2016, and we're going to go ahead with our assets, put in our dollar signs, capital, and liabilities, put in our dollar signs, and then we're going to start off with our non-current assets. The first one would be our fixtures because it will be in the business the longest. So that figure didn't change, so we just write it back. Then equipment will definitely be a bit longer in the business because that's what we're going to be using on a day-to-day. We're going to be using throughout the years. We're going to have that first, and then we have our motor vehicle because motor vehicle can be easily sold. All right, so we're going to have that. Motor vehicle didn't change, so we add that. Then we're going to ensure that we add up all the figures. All right, let's look at that. Yes, so this is our total non-current assets. Then we're going to go to our current assets, and we have our stock that also changed to 8,250. Our debtors that changed because somebody paid us, so it decreased. And then we have our cash at bank, cash in hand. What cash in hand is what the business has at the business place, while cash in bank is actually the amount of money that they have in their bank account. So we're going to add this up. This is our total current asset. We're going to leave the adding for last. Then we have capital. Capital is 27050. Sorry about that. Last column. Then we have our long-term liabilities. And that is our loan from RSIMS. Put the amount. That changed as well because we paid back. Then we have our current liabilities. And there was only one, and that's the creditor. So we're going to write it in the last column, and that is 5,200. So once we have gotten all of that, we're going to go ahead and add up our total non-current with our total current, and we're going to call that our total assets. And then we're going to add up all the capital plus the liability plus the current. And you realize that they are both equal. Now they remain equal even as we look at the first sheet. They remain equal because when we were doing the transactions, we always adjusted two accounts, whether two assets, a liability and an asset, a liability and capital, two liabilities. We made some adjustments, so it will remain. So asset will always be equal to capital and liability. All right.